I don't think I've ever met a small business owner that didn't understand their income statement. You know, the good old P&L or profit and loss statement. And most of them kind of get what the balance sheet is all about. But many don't understand the cash flow statement. I think this is a shame for a couple of reasons. First of all, cash is the lifeblood of your business. My finance prof had a cute little saying, if it doesn't jingle, it doesn't count, which I've only used around 12 gajillion times to impress upon my clients and students the importance of cash. So that means that your cash flow statement is the most important of all the financial statements. But in my opinion, it's also the easiest to understand. So to fill the gap, I thought I would take a few minutes and explain what it is and how to read it. Okay, so what we have here is the summary page from my 3-year financial planning model in Excel. And you can see that there are 3 sections to the cash flow statement. There's cash from operations and cash from or to investing. And so from means that there'd be a positive figure, and to would mean that cash left the company on a net basis. And then cash flow from or to financing activities. So first looking at operations. So this basically covers everything that's going on in the business on an operational basis. So this is paying our suppliers, paying all of our expenses, our employees, the landlord, that sort of thing, and then collecting from customers and paying our bills to our suppliers, all of that. And we break it into 3 lines. So first of all, net income. Now generally we want this to be positive, of course, because we want to be profitable. And then we add back depreciation. And this is a little bit of a quirk that confuses a lot of people. But essentially, the reason why we do this is because when we calculated net income, we subtracted a figure for depreciation. However, that's the only item on the income statement that actually didn't involve the checkbook. It didn't involve money coming either in or out of the company. It's a non-cash expense. And so we add that back onto the net income to come up with a sort of a cash from the income statement figure. And then we want those 2 to be positive. And then we have changes in working capital accounts. So this is everything on the sort of the top half or the current portion of our balance sheet. So that involves paying our accounts payable, collecting customers via accounts receivable, investing in inventory, looking after our taxes, all of those sorts of things. And generally in what I call a normal, healthy, growing company. So this is the subject that I use when teaching small business. This is a normal company, meaning it's not a startup. It also means it's not super high growth. It's healthy, so it's not in trouble. It's a normally healthy company, and it's growing, because a normal company should be growing. And in a normal, healthy, growing company, this one actually should be negative, because that would imply then that we're investing in working capital on a net basis. And so that's what we want to see. We want to see this one be negative. The first 2 should be positive. And then absolutely not negotiable is that the total should be positive. The total cash from operations has to be positive. That means then that operations is throwing off cash for us to be able to invest in assets and to be able to cover our pay down our debts and that sort of thing. If this is negative, that means that we're finding cash somewhere else to cover operations. So that means you're either selling assets or you're borrowing money to cover losses. And that's not a sustainable situation. Okay, the next section is cash flow from, or actually it should normally be to, investing activities. So this is purchasing of capital assets, which involves things like machinery, vehicles, land and buildings, that sort of thing, computers. We want this one to be negative. In a normal, healthy, growing company, it's negative because we are on a net basis investing in assets. Now, can it be positive 1 year? Sure. You could have a year where you happened to sell off more assets than what you bought. But that's not a long-term sustainable situation. That's just an anomaly. Normally, we want this one to be negative. And then lastly, we have cash flow from financing activities. So this involves all of the cash that's related to our investors and our lenders. So issuance or paying down of debt, and then issuance of new shares, or even better, paying out of dividends. So this one can be either. It can be negative or positive. It kind of depends on the year. You can see in this example we have a positive in the first year, and then the next year it's negative. But you'll notice the other ones, cash from operations in both years is positive. Purchase of assets in both years is negative, which is what we want to see. And the financing is kind of we don't really know. It depends on the year. And it really depends on whether or not on a net basis that year we paid down more debt, let's say, than we were issued. And then whether or not we decided to issue a dividend could be a big factor as well. And then what we do is we take these three totals, so the total from operations, the total from investing, and then the total from financing, and we total those up to come up with a net change in cash. And you can see here it was a positive $40,000. Then we simply apply that to whatever the beginning cash balance was. In this case, it was roughly $250,000, and we end up with $291,000 of cash. And then this is the figure that you'll find at the top of your balance sheet. So there you go. That's the cash flow statement. Pretty simple, really. You should review this statement every month, along with the balance sheet and the income statement. It tells you at a very high level how the business is doing along that most important of dimensions, cash. And remember, if it doesn't jingle, it doesn't count.